I'm joined from Hong Kong by Stephen Roach, the chairman of Morgan Stanley Asia. Mr. Roach, thank you so much for joining us on the show today. Now, it does seem like we're just not getting the good news that we're hoping for out of Europe. How concerned are you about the situation over here?
Well, Francine, I think it's pretty clear that post-crisis recoveries tend to suffer from the combination of deleveraging and periodic aftershocks. We're seeing signs of both, and Europe, in my opinion, is very much an aftershock of the subprime crisis, which led to sharp recessions and revenue shortfalls in the heavily indebted economies of Southern Europe, and the deficit to GDP, debt to GDP ratios have blown up as a result, and this region is now going through a wrenching will have to go through a wrenching fiscal consolidation, which will take a protracted toll on economic activity and with potential spillover effects to Northern Europe and the broader global economy.
So are you concerned, just like the U.S. is saying, that actually the austerity measures in Greece will push this region down to possibly a double-dip recession?
Well, I think for the economies in Southern Europe, Greece, Portugal, with some potential risk, in Spain and Italy, fiscal contractions, fiscal consolidation will certainly raise the distinct possibility of a double-dip recession. For the broad Euro region as a whole, I think it will be able to avoid an outright contraction, but it'll be very weak and anemic growth, again, with broader implications to the rest of the world, which depends heavily on cross-border linkages through trade flows into Europe.
But, Mr. Roach, how concerned are you actually about the credit freeze for the European banks? The ECB is giving immense support to these banks, but a lot of the analysts are saying this could end up like a second Lehman Brothers here in Europe. Do you share those concerns?
Well, I hope not. The European authorities have learned a lot from the Lehman and post-Lehman experience. Keep in mind that in the United States, TARP was concocted after the freezing of the markets post-Lehman. And the European authorities, in conjunction with the IMF, have put in place this 750 billion euro facility prior to the risks that could be bearing down on core European banks. So this has been a little bit more preemptive than reactive in the case of the Europe, and hopefully that will be sufficient to forestall a broader freezing up of credit intermediation in Europe.
Now, what some of the market analysts are asking is, well, now the focus is on Europe. We have these bond vigilantes coming into our region, trying to either push the levels down or definitely try and push these bond down. What happens if the bond vigilantes will go to the United States or other parts of the world where we see similar deficits?
Look, excess sovereign debt is a problem that is endemic in the developed world right now. And at this point in time, we still have ample slack in the global economy and a notable absence of inflationary pressures. But with central banks likely to remain excessively accommodative for, to use Ben Bernanke's word, an extended period of time, with fiscal authorities likely to keep stimulus packages in place for equally extended periods of time, then the current benign environment for inflation could give way to more serious inflation down the road, and then the bond market vigilantes will be well positioned to drive longer-term sovereign bond yields a good deal higher.